Welcome to your next training video on ACCA F8 Audit and Assurance paper. The topic of this will be audit evidence. First, I would ask you, or rather just reflect a little bit, why the auditor needs evidence. Why do we need evidence? Evidence is something, probably an object that will prove something. It's something that it's tangible, right? It is very similar to a court case. Just imagine that someone goes to court because it has been accused of theft, and the jury could not simply say whether someone is guilty or not just based on its appearance. The similar thing is going on with auditing. The auditor, basically the objective of the auditor is to issue an audit report, but if something goes wrong, the auditor must prove that he has done everything properly in order to issue that audit report. And how does he prove this? He proves using the audit evidence he produced during the audit work. If he did not save audit evidence based on which he issued the opinion, he can basically be accused of professional negligence because he did not document the audit engagement as the international auditing standards require. So, in terms of your exam, most of the exam sessions have a regular question on audit evidence. Usually you need to be able to demonstrate that you have the ability to apply knowledge in a practical way in terms of audit evidence. You have a scenario, and then you have to say what kind of evidence would you seek for and what would be the procedures used to gather the evidence. But you also might be able to get some marks just by reproducing theory. Before going into financial statement assertions, I would go to the next section of the notes, audit evidence. So as by ISA 500 audit evidence, the auditor must always look to obtain sufficient and appropriate audit evidence on which to base their opinion. Nevertheless, he has to document this. Why? What should we take into consideration when we discuss about the appropriateness of the audit evidence? This has to be relevant and reliable. And in terms of sufficiency, sufficient is just, let's say, enough to cover the audit risk. So if we discussed in our previous sessions about audit evidence, about audit risk, then we know that we have to design the audit procedures in such a way that it covers the risk and reduces the level of the audit risk in such manner that we can obtain reasonable assurance about the true and fair view of the financial statements. So sufficient would be enough to cover the audit risk that the auditor identified. It's a matter of professional judgment though, and will be influenced by factors like the nature of the business, size of the business, the auditor's past experience and knowledge about the client, and the industry maybe. So this is what he will help the auditor to reduce the audit risk and to ascertain whether he needs more evidence to cover that risk or not. Appropriate now is relating to the quality of the audit evidence, right? If sufficient is dealing with the quantity, I would say, of the evidence. Now, appropriate, i.e. relevant and reliable, deals with the quality, right? So relevant is something that depends on the nature of the item that is being tested and the assertion that's being considered. We'll discuss assertions a little bit later. And in terms of reliability, that's a little bit more difficult to discuss because reliability of audit evidence is depending on lots of considerations. For example, documentary, so something that's in a document, is more reliable than oral evidence. Or you can say that client originated might be less reliable than the ones that are held by originated by third parties. For example, bank statements or supplier invoices. For example, bank statement can be also obtained directly from the third party by the auditor, and then that's more reliable. What is the most reliable evidence, however, is what the auditor itself generates, right? So that is something that we know that has no bias. Okay, now let's go back to assertions. What are assertions? Financial statements assertions. When the client's management is preparing the financial statements, he's making a number of assertions. It's kind of a declaration. Right? They are posting some balances and some figures in the financial statements, and behind those balances there are some assertions that they are complete, they are accurate, they are reliable, and so forth and so on. The auditor needs to obtain the audit evidence that these assertions are reasonable, and then they can form an opinion as to whether the financial statements give a true and fair view about these figures. Right, so these are the financial statement assertions, what a financial statement user will believe about those figures. There are three categories. There are assertions relating to transactions and event. I will simply call them the ones related to the statement of comprehensive income. The assertions related to the account balances, these are the statement of financial position, so the balances, and presentation and disclosure may be the notes. Right? So in terms of the statement of comprehensive income, we can discuss about assertions like occurrence. So an amount that figures in the statement of comprehensive income must relate to an event that has happened or happened in the past. It occurred, right? There's no future events, no future amounts recorded in the statement of comprehensive income. Completeness, for example, all the expenses related to sales were recorded in the statement of comprehensive income. Accuracy, revenue adjustments were calculated correctly. Discounts allowed for clients were calculated correctly. Cutoff, only revenues and expenses are recognized in the statement of comprehensive income that belong to the current accounting period, not the future ones. And classification, we do not mix the different categories, so there is no admin expenses charged to cost of sales and the other way around. These are figures that we assume as users of financial statements that are true in the statement of comprehensive income, and these are the ones that are backed up by the evidence of the auditor, and they are true. Based on this, we can say that the financial statements do provide a true and fair view. Similar to the account balances, the statement of financial position, we want to know that, for example, inventory and other assets exists, but they have the right to collect some accounts receivable, and we have the obligations to pay some accounts payable. So all the obligations are presented, meaning all of them completely were presented. And they are valued and allocated properly in the statement of financial positions. For example, valuation, inventory accounts, receivables, other kind of assets, they are valued according to the relevant standards. And to disclosure, occurrence, rights and obligations, completeness, classification, understandability, accuracy and valuation. As the presentation and disclosure mainly relates to the other elements above, the assertions kind of repeat themselves because they are just the explanation of those figures. Now, what kind of procedures can the auditor use to produce audit evidence? ISA 500 audit evidence will indicate us 8 procedures and combination of those which may be adopted by the auditors in order to obtain audit evidence. It is inspection of records and documents. Start looking at documents, inspecting a pile of invoices, a selection of invoices, to make sure that all the documents that were, for example, all the invoices that were issued are also recorded. Mainly that would be on the other side. All the invoices that were received by the company were recorded, for example, or all the contracts. Inspection of tangible assets to make sure that whatever we recorded in the company's balances do exist. Note that when we are discussing an audit procedure, we think about an assertion. We want to prove an assertion through an audit procedure. Observation, again, that assets do exist, for example, or a procedure, inventory count is carried out properly. Inquiry, asking management about, for example, estimations, how the value in use of non-current assets was calculated. Confirmation, that's confirmation of a bank, for example, a third party confirming a balance, a bank or a supplier or a client. Recalculation, that would be recomputing some kind of figures, for example, discounts allowed for customers, recomputing them according to the contractual provisions and the amounts that were invoiced to the clients. Or reperformance of some kind of procedures, and analytical procedures, that these are comparing different figures, making sure that our assumptions or our expectations related to the balances in the financial statements are valid. For example, growth of revenues related to growth in cost of sales. That will be our session about audit evidence. In our next session, we're going to also discuss something more about inventory.